Welcome, everybody, to another episode, actually, our sixth episode here of Mortgage Insiders Edition. As always, my name is Kim Nguyen, and alongside me is Preet Singh. And on this week's edition, since we are in a seller's market, we thought it'd be pretty good idea and time to chat about conditions of financing. Whenever we're in a seller's market, one of the biggest things is you got to think about how can you make your offer stand out? And one of the things that we have seen recently is conditions of financing and whether or not to put it on your contract or not. So Preet, tell us a little bit about, what that looks like and also some risks aside with that.
Absolutely. Thank you, Kim. So hello, everyone. So welcome to our Mortgage Insider Edition. So whether you're listening it on a podcast or watching this video on YouTube or other channels, welcome. So as Kim mentioned, we are talking about a very important topic, and this topic always comes up when it's a very hot market. Our realtor partners and builder partners are always in sometimes very stressful conditions, and they are always trying their best to accommodate all the clients, but sometimes they have to go with unconditional offers, even though they know that it will be a multiple offer situation or other kind of situations would be possible, right? So what we will talk about in this episode, very briefly, we will talk about few risks involved going with unconditional offers. And my colleague Kim will also talk about some experiences that we have basically, let's say, seen in the past with our experience, right? So touching on what is a conditional offer or unconditional offer. So when you are purchasing something, in this case, it's real estate, as a client, you are saying, okay, I will buy this property based on these conditions. And those conditions normally are major three conditions. The first one is a condominium documentation review if you're buying a condominium, and that condominium documentation has to be reviewed by let's say a lawyer or a condo doc review company. If you're not buying a condominium, then the other two main conditions are financing condition and the basically inspection condition. These are the two normal conditions that always go in. So when you are not placing any of these conditions on the offer that you're giving to your seller, then it means it's an unconditional offer. It means you're buying it unconditionally. The moment that offer is accepted by the seller, the property is pretty much sold. Only thing that you have to do is exchange money through the lawyer's office, right? So then you are liable in that scenario that you have basically given your commitment to the seller that I'm buying your property for X amount. Kim, I'm missing anything on this?
No, and just to add on that too, and for some of our viewers, you guys may be wondering like, well, why would anyone do that? And especially in a hot market like it is right now, where it's a seller's market, to make your offer stand out amongst a million other offers that could be placed on this particular property that you want to buy, if you have no conditions, that means you're taking this home no matter what, right?
Absolutely.
Like, this is your home. Like it's almost in the eyes of a seller, this means that if I accept your offer, I'm getting my money regardless, right? So that's why your offer would stand out a little bit more. But again, there are risks to it because if you can't get financing for whatever reason, or if let's say the property inspection falls through, you're on the hook for it no matter what, right? But we're going to talk more about like what the consequences really look like in the financing side. So
absolutely. So if you are basically, let's say, going unconditional and there's no financing condition, there's no property inspection condition, and let's say for worst case scenario, the lender basically likes you, but they don't like the property. So when we basically give you an approval on a real estate transaction, whether it's a commercial transaction or a residential transaction, when it's the real estate backed, it's always a twofold approval. Or sometimes it's a threefold approval. Basically, it depends that how strong you are there as a client, like what kind of strengths you bring in, credit history, down payment, income stability, all that stuff. And how basically the property stand out. Is it too old? Is it too micro condo, or whatever kind of scenario, space-wise, where it is located? Maybe it's located too rural and the lender is maybe not even interested into it, right? So these risks regarding the property are always there. The bank lender will always put a strength or let's say focus on where the property is located, what condition it is. And especially when we have seen is people are going with unconditional offers. Sometimes clients are basically looking into foreclosure properties, and those properties may be rundown properties. There may be grow up properties. There could be, let's say, marijuana growth, or it could be other things could be there. Asbestos could be one of the reason that it has to be remediated, that kind of property, right? So these risks are always involved. Bottom line, the lender is basically looking at you and the property also, right? And then they may also have to do an appraisal on the property. And then if you're going unconditional for some reason, let's say the appraisal of the property does not come up as a valid number for them, then that could also jeopardize your approval at that time. Having said that, when I said it's a threefold, sometimes we are going to the insurance companies also for getting an approval, right? In some certain cases, basically, we have seen is some, let's say, properties are already flagged by insurance companies in the past due to, let's say, flood water damage, or roof is leaking, or something else is happening, and that property is flagged already. And that lender may be, and the lender that we are dealing with may not be even aware of that, but the insurance company is already aware of that, right? So the insurance company will advise the lender and the client or me that we are not moving further. So in those kind of scenarios, an unconditional offer would become a very risky one. It doesn't happen every day, but Kim and myself are talking today where we have seen some horror stories, right? So that could happen every day and any time.
Yeah, and like, just to kind of elaborate again and summarize, the one thing that we want to share with all of our listeners is that, remember, just because you're pre-approved doesn't really mean that you're fully approved, right? When you're going out to buy a home, like, the lender looks at twofold or threefold. So really, they could love you so much as a client, say, Mr. Customer, Mrs. Customer, you guys are great. We love you as a client, but really the home that you're buying, we don't love. This home was an remediated grow up. We don't lend on those homes, right? And again, like, if we take it an extra step further, like, let's say you're buying a home with less than 20% down, you got to go through 3 stages or 2 stages of approval, right? The lender has to have first step blessing, and the second blessing is the insurer. The lender could perhaps look at the home and say, yeah, we love you as a client. We love this home as well too. But then when it goes to the insurer, that is the final step. There could be something behind the scenes that nobody knows about. And again, now you're on the hook, right? You put an unconditional offer, we submit it for financing, but because of X, Y, and Z reason, we can't get financing. So, but it's not but I mean, kind of like going back on that, sometimes an unconditional offer can work too. Like, it just really depends on the circumstance. And I know one of the biggest circumstances, well, do you have backup money? Do you have backup down payment, right? That could be one way to mitigate the risk, because if you're doing a down payment less than 20%, know that you got to get 2 stages of approval, right? The lender has to say yes, insurer has to say yes. But if you're doing 20% or more, then it becomes the lender has to say yes. But at worst case scenario, if your traditional lender, like your regular bank lender, says no because maybe this home is too old, it has asbestos, or whatever the case is, we can always go with a private lender. And with a private lender, again, interest rate may be a little bit more, but they're more based on equity lender, which allows us to get that financing, fix whatever the problem is. If it's an asbestos problem, we fix that problem, and then we refinance, meaning we transfer it back basically to the regular lender when the property is in better condition.
Absolutely. Yeah. So when you mentioned about the insurance and the conventional side where your down payment is 20% or higher, something came to my mind. Like, if you're a first-time home buyer, then we would basically recommend you that definitely you should basically go with a conditional offer, right? When you are a first-time home buyer, putting 5% down, minimum down, and let's say, and that money is also sometimes gifted from different sources, right? There are many variables involved. Then definitely go with a conditional offer. Do not take that risk to go unconditional. But let's say if you have been a seasoned home person, you have been in, let's say, buying properties, selling properties, and your principal residence is free and clear, you have a $500,000 sitting on your line of credit, which is unused. Yes, then there are possible scenarios you can take the risk and buy the property cash, even if as Kim mentioned, you don't want to go with the private lender, fine. You can buy the property cash and then refinance it later on when everything is in your name. So these kind of scenarios could work out. We're not basically discouraging you to not to go with that. What we are trying to say is you have to be very careful and make sure that you have a fallback position when you are going into an unconditional offer. So these are a few things. Kim, you would like to share some experiences from the past? Anything that comes to your mind?
Yeah, I think like the one thing too is just like, just talking about previous deals and stuff, like I think I've seen it all, right? And for viewers, they're probably wondering like, so Kim, what constitutes as like a bad property, right? Like what would lenders not lend on? And some of the experiences I've seen is there was a home that a client of mine wanted to buy. So it was a foreclosure home. And again, like very, very good pricing because when it comes to foreclosure, you're buying the home as is, right?
Yeah.
And the thing is, I had a very strong client that put an offer on unconditioned because, they really wanted the home. They said, Kim, like, I'm going to make mad money off of this. But then eventually, when we go to submit for the financing, one of the big hiccups was it was a remediated grow up, right? So right off the hop, it limits our pool of lenders to only a few. And the problem with that is because it was also, sold as is, and there was also a condition on there that you could not go in and do an inspection, freaked out. The lender was like, oh my gosh, there could be more things wrong. We don't know. We want to step away from this. So things like that could happen. I've even done homes where, everything looked good. Nothing was disclosed on the MLS or anything. Like the home looked perfect. But then in the back end, when we sent it to the insurer, they said, hey, this condo building has been flagged because there's been issues, right? There's been issues with management. There's been issues with X, Y, and Z. And again,
condo reserve fund, that's the biggest one. Yes.
Reserve fund, and like sometimes these are things that we can't see, a lender can't see, a realtor can't see either, right? Like sometimes these are very, very hidden things that we just don't know until we submit. And then even I think one of the weirdest ones I've had is I had a client buy a home where there was a murder that happened in there, and because of reputational risk, they were like, no, Kim, like sorry, like we know the history of this home because there was there was a note on it or something like that, and they knew that there was a murder that happened in the home, and for reputational risk, the lender was just like, no thank you, right? We don't want this home in our business. So
absolutely.
Yeah, crazy stuff.
Absolutely. So yeah, these things happen every day with us, and sometimes we see some good wins from unconditional offers, our investor clients especially, and they win basically with some offers. But again, we also caution that be basically very much prudent about when making these deals. And if everything falls into place, then yes, you will have that property. But if not, then you will be liable for that commitment that you have made to the seller, right? So, Kim, I believe this is good for today's topic. If you guys have any questions, you can always call both of us or any of us, and we would be able to help you out. Kim?
All right. Thanks everyone for tuning in, and we'll catch you next time.
Okay. Take care, guys. Bye-bye.